Okay, so once you know how accounting T accounts function, the next thing we have to do is start recording transactions using the T accounts. So we're going to ask ourselves 3 questions for each transaction. What accounts are affected? Is the effect an increase or decrease? And does that translate to a debit or credit? Now, in the beginning, you'll probably have to formally ask yourself those 3 questions. As this process goes on, it will become second nature, and you'll be immediately able to jump from 1 to 3 without even thinking about it. Now, as far as other rules you need to know when recording transactions, you have to remember that there will always be at least 1 debit and 1 credit. You're never going to have a transaction that involves only debits or only credits. There will be at least 1 debit and at least 1 credit. And also, when we record our transactions, the debits and credits for each transaction must be equal. So just like we said in the beginning, when we keep the accounting equation in balance, we keep each individual transaction in balance. And just as a general industry rule, we record the debit first. So we're going to pick up that habit now as we start our T accounts, and we will see that stay with us throughout the rest of the course. Okay, so we have our examples here of what the T accounts look like and how they function. Assets increase with a debit, decrease with a liability, and have a normal balance on the debit side. Liabilities are on the right-hand side of the equation. They increase with a credit, and they have a normal balance on the credit side. Now, owner's equity, our parent account here is capital. It increases with the credit, and normal balance is on the credit side. It's on the right-hand side, and that's how it works. We have these feeder accounts that go in owner's equity that are going to, in the end, impact capital. Revenues operate like capital. They make capital smile. Expenses and drawing, however, are going to reduce capital, and they work contrary to capital. So we increase expenses and drawing with debits, and the normal balance side is on the debit side. Okay, having said that, we're going to look at some sample transactions. We're going to use our debits and credits to do that in the T account, and we're going to remember these 3 questions as we go through and analyze each transaction. So the first transaction, owner invests $50,000 in the business. Now, what accounts are affected? As you know, that's going to be cash and capital. Is cash increased or decreased as a result of this transaction? We know that it's increased. So if I'm going to increase cash, will that be a debit or a credit? We increase cash with debits. So that's a $50,000 debit to cash. Is capital increased or decreased? It is increased, and we increase capital with a credit. So my first transaction is simply debit cash, $50,000, credit capital, $50,000. That's it. Okay, the next one. Buy supplies with cash for $1,000. First question I ask is, what accounts are affected? Well, I spent cash, obviously, and I now own some supplies. Supplies are an asset. We increase supplies if we own more of them. That translates to a $1,000 debit. Cash is also an asset, but as a result of this transaction, we have less cash. We have to decrease our cash, and we decrease assets with a credit. So again, our transaction, we have a debit to supplies and a credit to cash. And the third transaction, sold services on account for $10,000. So, what 2 accounts are affected? There's no mention of any cash being involved here. We sold services on account. That tells me that was accounts receivable, which I'm going to abbreviate AR. And we also made a sale, so that's going to be revenue, or some people might call it service revenue or sales revenue. So these are our two accounts. Accounts receivable is an asset. Did we increase accounts receivable or decrease? Accounts receivable is now more. It's $10,000. So we debit accounts receivable with the $10,000. We have earned more revenue now. We show an increase to revenue just like we would increase capital or owner's equity with a credit. So the result of that transaction is a debit to accounts receivable of $10,000 and a credit to revenue of $10,000. Now, these are just a few samples, but we're going to see that every transaction will have at least one debit and at least one credit. We're going to see that our debits always equal our credits, and you will notice that I started each transaction with the debit. Now, initially, that may be a little bit difficult for you to remember to put your debit account first, and that's okay. Just start walking through these steps, writing down the accounts that are affected, then decide if it's an increase or decrease for each account, and what that means. Is that a debit or credit? And we'll pick up from there.